Hello and welcome to the Harwood Report for April 2nd, 2019, presented by Trade Academy. I'm Keith Harwood, the founder of Trade Academy. Let's do our disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of these and then we will get into the charts. All right, that should be enough. So what I really want to talk about again today, a little bit of focus on this, and this, a little less on this. And I'll tell you why. It's a little harder to find a good trade in the bond stuff right now. But we've had some interesting movement in the S&Ps, NASDAQ, small caps. And then I think gold and silver have a really interesting setup because we're going into non-farm payrolls on Friday. And that can be a nice little trigger for a move there. So all that in mind, let's go first to the fact that we're showing neutrality on a lot of these elements, which is actually a really nice thing. And I'm not going to go through all of them because right now I actually tend to agree that a lot of them are neutral. But, we look at stock price strength, stock price breadth, all that other stuff from this fear and greed metric. A lot of it's neutrality. I don't know that I would call too much of this stuff extreme fear, but at the same point, that was a pretty big hedging activity, it looked like, in the put-call ratio a couple days back. And now we're rallying anyway. So what do we see here? Big breakout. Massive move on Monday, yesterday, April 1st. So we had this great move, got us above the high from March 21st. So all of this stuff means that we're still seeing buyers of the dip. We're starting to return to some of that normal activity that we saw in, say, 2017, where people buy dips. Now, the dips are getting pretty shallow, similar to what we saw here. But if we see a big breakout to the upside, taking out this high from September 20th, which was 293.94, dividend adjusted, it's a little bit lower. But the main idea here is that we're about 2 to 3% away from a new all-time high. Okay, and if we get that number, that move, I think we're going to start to see some potential FOMO, causing big movement, and then that can create a pullback. But we haven't really seen that FOMO, oh my gosh, fear of missing out kind of rally where people are panic buying. We're just seeing seemingly normal allocation process where, generally speaking, I would expect the market, if it's just going to drift higher. Why does it drift higher? Because people are investing in things like their 401ks. So as you put money into your 401k, that money then goes into the stock market. That creates higher prices. So just generally speaking, that's sort of what we normally see as a normal process. People aren't normally liquidating, retirement accounts and things like that as a normal process, as a normal daily process. The other stuff that we saw, obviously, that kind of helped trigger this was that there was some good news out of China. Okay, so they had some good manufacturing data. But that's a big move to see that move through the March high. And now, I think that maybe we get a little bit of resistance near the previous highs, but we seem to be wanting to set up for that new all-time high. In the process, what do I think is going to happen to the VIX? Well, I think the VIX is going to start to fall further. I think we're going to have an 11 handle. So if we're going to get the VIX down to 11, into the 11s, then what do I want to do with my trade? Well, it means that I'm expecting volatility to drop into a rally. That's my two-part thesis. I expect volatility to drop. I expect stocks to rally together. I can create an option strategy, such as a call spread, that takes advantage of those two elements hand in hand, where I'm long delta, long directional exposure, looking to be long the market, but I am short Vega as we rally. So I can be long Vega now, but when prices get higher, I want to be short Vega. A call spread achieves that. What it does is it has a situation where it is long volatility. If you use an out-of-the-money call spread, you're long volatility at the initiation of the trade. But as we move from our long strike to our short strike, the position becomes short Vega. A great type of setup when we expect volatility to drop and the market's not pricing in a big enough drop in volatility. Again, I talk about a lot more of this sort of stuff in the actual premium product, the newsletter that I sent out yesterday with some of these ideas, and then that also comes with a midweek update. But let's just keep moving through here on the other sectors because they're all showing a little bit of similarity, but some differences. First off, the Qs. We have QQQ, the tech and NASDAQ. Why is this not loading? There we go. Let's try one more time. We have QQQ, and that is a little bit higher than S&Ps relative to where we were in September and October. We're already kind of in that range, but we're not above the March high yet. So it's kind of lagged a little bit for the last few days, but overall it is leading this market higher. And we see that really coming through in the semiconductors. So the semiconductor index took out the September-October high, but that September-October high was not the all-time high for semiconductors. We had higher highs in March of last year. So as we see this sort of stuff coming through, I start to think, okay, well, tech has been the leader, but small cap may get some money rotation, because we start to see this situation where, generally speaking, and it's not always the case, but generally speaking, people expect small caps to outperform when the market is kind of doing that blow off top. Okay, so if I think we're going to get towards a blow off top, what's going to do the outperformance in that process? It's got to be well, to me, I think it should be IWM. We're seeing IWM above most of the moving averages, but really had a tough time getting above the 200-day moving average. It did lead the break in October, November, December. It led kind of the initial recovery, and then tech took over. So you see a different shape here. We didn't get a new high on March 20th in IWM or 21st in IWM when S&Ps and Qs were breaking out. We made our high in February for small caps, and it's been kind of drifting lower since then, creating a little bit of a downslope here. And if we can take out some of these highs, and really what I'm looking for is a takeout of that 200-day moving average, hold above it for a day or two, and then I think that sets up IWM to get back towards that 170, 171 level, the previous highs. And it could do so faster. So, we could see a situation where in the same amount of time, this is not going to take days, it should probably take weeks, if not maybe months, but in that same amount of time where the S&Ps may rally 3%, we could see a theoretical situation where IWM rallies 10% in that same time period. And that's why I get a little more excited about IWM as a higher leverage play. Okay, so that's what I just wanted to point out here. I think there's more leverage in the upside in IWM. I think there's more upside to IWM, and I think that it's an interesting sector. Big sector, like we're not talking about going into like specifically XLF, even though financials are a big portion of the small cap index. I think that this is just a bit of the money rotation play as people start to look for where the value is as we start to go towards new all-time highs. I mentioned TLT. It's a tough trade right now, and I think this is part of what's causing IWM to lag. So IWM has a lot of those financials, and the general rule of thumb or the expectation is that when interest rates are falling, which would coincide with TLT rising, that financials should underperform. We really had a big high made in TLT last week, and it started to break, especially with this good data out of China. And I think that what we're seeing here is a potential that this might just be too high. This move right here was kind of crazy. Volatility has gotten pretty high here. The clarity on the technical signals isn't there. I wouldn't be surprised to see a move back towards 121, but it's a hard trade here. But I can watch this. Now, if TLT continues to fall here and gets back below, say, the low of March 22nd, then people may start talking about filling that gap all the way down to 123. And that could help create that outperformance for IWM as people start flowing money into financials on a break in bonds. More exciting to me than that is what's going on in gold. So I mentioned before, the gold's getting interesting here. The dollar is testing its highs. So if dollar is testing its highs, gold should be testing recent lows. Another important one is dollar yen. Dollar yen is testing, recent highs. Kind of looks a lot like IWM, frankly, but we'll see if that can kind of get that rest of that outperformance here up towards 113. If that gets that kind of move and dollar takes out the previous highs, that should be bearish for gold. When dollar is strong, gold tends to be bearish, and we are testing these lows. So we've got a little support here because we've had some consolidation periods down here, and people have been looking to buy around this price point. Well, if it starts to break and we get through these lows, we could see a massive collapse down towards 116. That's a pretty good break in gold. There's a lot of leverage and a lot of ways to make money there with just outright puts. I just want to have a little bit of time just in case something weird happens. Now, reminder, non-farm payrolls on Friday. That comes out with good, strong data. That could be really strong for the dollar and really bad for gold. So we have a catalyst this week that could really trigger some selling. And I'm watching that one closely. And as a result, silver is another one that I got to keep a close eye on. Now, silver has not had the same performance as gold. You can see that the chart is generally worse, right? And we're close to these lows. And it hadn't had as big of a blowout to the high upside. And it just looks like it's setting up for a move to 13.5. And options are generally cheap right now in the precious metal sector. So I think there's a lot of ways to play this with outright puts. Finally, we'll go to oil. And when I talk about oil, obviously I'm looking at the major move we've seen today. Through the 200-day moving average, and it's a big breakout. And yet, XLE, not really doing much. OIH, not really doing much. So I think there's a lot of potential here. If oil's really this firm and oil has that bullish input, I think OIH has a potential for a breakout. Now you see that the high from February 20th was 1806, and the high here from March 20th was 1794. So 1806 is a big level. Today's high, 1797. So we're really kind of testing around that with OIH, and I think if we get above that level, there seems to be a magnet potential here to the 200-day moving average, which is almost $3 away. Okay, I get that we're not doing anything special here today, we're around 1764, but there is some potential here. If we get another 2-3% rally in OIH, which could easily happen in a day, that sets up for a much bigger move to the upside. So I'm just really keen in on here on the oil sector because of what's going on in oil itself. A lot of times those oil names lag a little bit on the oil move because there's an expectation that oil will just come back down. But if oil continues to rally here and starts to really fill that gap and gets up to 14 and a quarter, 15, this is USO. If I took a look at it in actual crude oil futures, so you can get like some futures type pricing here. We're looking for that move up here towards $70 oil. $70 oil, I think we're going to start to see some real money flow going into these oil sector names. Okay, I mean, even here above 60, seems like there should be more money flow going in there than when prices were around 52.5 in oil, and OIH and XLE were here. So I think there's a lot of leverage there. That's what I wanted to key in on that for you guys. All right, as a reminder, the premium report is $49 a month, but you get that first week free. So why not try it out? Take the first week free. Get the newsletter on Mondays, so a day earlier than this free video, with more information, and then get another video in the middle of the week for your weekly update. Okay? Go to tradeacademy.co, there's no M, /Harwood Report to sign up, or email me, keith@tradeacademy.co. Again, no M. 312-600-8004 is my phone number, but email is usually the best way to get a hold of me. Thanks again, folks. Have a wonderful rest of your trading day.